Hi, this is Brian at Leelyn Smith with your second quarter 2024 update. And remember, at Leelyn Smith, we try to reach client goals with the least amount of risk possible. Okay, this video is titled Knock on Wood, and I'm borrowing a phrase from Federal Reserve Chairman Powell, who recently spoke and said, the economy is in pretty good shape, knock on wood. So we're gonna take a look underneath the hood and see what he's talking about and how that impacts any outlook that we may have for this quarter. So the main things that we're gonna cover are inflation and interest rates, the labor market and consumption, and then GDP and the market. So let's dive into inflation. So always remember this, inflation and interest rates are joined at the hip. And that's because interest rates are the main tool that the Fed uses to deal with inflation and to slow down the economy or to speed it up. And inflation is getting closer to normal. That downtrend should continue, especially for housing inflation. Housing has been the largest contributor to inflation since about middle of 2022. Accordingly, the Fed has kept rates higher, but eventually those rates have to be reduced. Basically, the Fed is playing a game of chicken with inflation, and so far has been winning, getting that inflation closer to their 2% mandated target. So, yeah, they're getting inflation pretty good. It's not done yet, but they're in pretty good shape there. Now, labor market or employment and consumer spending. The media touts that our economy is about 70% consumer-led, that we're a consumer-driven economy. That's not the full story. The other part of that story is the employment side of the fence. And employment and productivity drive income, and income drives consumption. So part of the Fed's dual mandate, in addition to inflation at 2%, is full employment, which they consider 4% unemployed. The latest reading shows that we are right there. So the labor market has been strong, which means more people working equals more consumption. Now, consumption spending has been strong, but it is expected to slow down a little bit as savings return to pre-pandemic levels. Now, unemployment may rise a little bit as this slowing happens, but we are in good shape right now. So labor market, yeah, it's in pretty good shape too. Now moving on to GDP and the markets. So with inflation getting in line, employment strong, consumption strong, and now savings, hopefully savings getting back to pre-pandemic levels, the Fed is keeping rates higher, monetary policy tight to finish the job. That tightness is going to slow down the economy a little bit. We're already starting to see this a little, and it will slow down GDP. Notice that in 2024, GDP is expected to be lower and then resume after that. That's the expectation, that the Fed is going to slow it down, lowering rates, and then we resume an uptrend. Now, what does this mean for the markets? Well, for the bond market, it means more of the same. It means you want to be in short-term bonds. If you can, typically they have higher yield, and you don't need to go out far on the yield curve, and meaning you don't have to go far out in time. So short-term bonds are more attractive. For the equity markets, lower interest rates are generally better. And the market is anticipating that the Fed is going to lower rates, hence rallying up to this point. Now, so for this part, the GDP is normalizing and the markets are a little bit ahead of themselves, but we are normalizing there. So should we knock on wood? I think it's a little premature to knock on wood, but we should acknowledge that the Fed has done a good job so far. Coming into 2024, the second quarter was expected to see slowing. That appears that's going to play out, although it could be pushed over to Q3. I'll say this, a market correction would be good here. We're a little bit overvalued. And if we have a correction, we can then resume the long-term uptrend. Now, here's the bottom line. Market participants know that the Fed has to decrease rates at some point, and they're anticipating that. So the risks here are a Fed policy mistake where they drop rates too early and a market therefore getting ahead of itself. Hence, we would like a correction here. Okay, that's it for this time. Thanks for watching, and keep your eye out for our next quarterly video. And remember, at Leelyn Smith, we try to reach client goals with the least amount of risk possible. Thanks for watching.